Welcome to the AHQ podcast. We are joined with a special guest today, Chase Thomas. With the AHQ podcast, we like to help seasoned operators who are currently growing their companies from 2 to 75 million in EBITDA, as well as capital providers that are actively deploying capital, as well as M&A service providers to create an amazing ecosystem that is supportive of each other. Now today, Chase, he's the founder and CEO and a fund manager at Alpha Wealth Funds. As a certified financial planner professional, Chase works with business owners, entrepreneurs, and high net worth families to build, preserve, and grow wealth through strategic investment management and comprehensive financial planning. In this episode, we discuss capital allocation, market opportunities, wealth preservation, and the financial strategies that help entrepreneurs create lasting success. Thank you for joining us today.
Yeah, absolutely. Glad to be here.
Well, we've talked about obviously mitigating risk and pooled funds and all of that. But before we get into the intricate parts of what you do for a living, what started your journey to Alpha Wealth?
Yeah, absolutely. So from the very beginning, I had created my career managing money through Fidelity. And I hit a point in their company structure, so to speak, where I really saw that their business model was really based upon providing a small amount of value to the broadest possible pool of clients,
Mm-hmm.
right? And I'd been trading options for decades at that point, and I knew that there was a better way to manage risk and to manage assets, and that if I could pursue that rather than having this very shallow pool of value, so to speak, I
Mm-hmm.
could instead take care of a narrow group of clients and provide an incredibly deep amount of value for them. And so it was about 11 years ago now that I actually left Fidelity and started my own company, my own registered investment advisory firm,
Mm-hmm.
with the sole focus of to create a structure where I could create an incredibly deep amount of value for my clients, where I could show transparently the value I was adding to the accounts through the trading that we were doing. And that's really what started it. And so from the very beginning, the motto I always had was always be adding value. Any interaction that I had, any financial planning or investment strategy I implemented, I wanted to make sure that the client was better off, that I was better off, and that they were better than their comparables at all times as well.
Let's dive deeper into the value that you're creating for the clients that you serve and how you do that. I know, there's so many different ways that you do that, but let's talk a little bit about one thing that we touched on from the very beginning was to mitigate risk and de-risk one's investment. Can you go a little bit deeper into that?
Yeah, absolutely. One of the big goals that I had is from the very start, right, on the most conservative side of the market. So usually people would say idle cash or maybe cash under their mattress or generally high yield money markets is what a lot of businesses will use, or possibly even CDs or structured notes. The big issue with that is that right now with where interest rates are at, those are only yielding about 3 to maybe 3.5% for most people. And so it's really just barely offsetting inflation, right? And I know for a lot of business owners, this really eats away at them when they see they've got $1 million in cash and they've earned their extra $100 in interest this month.
Mm-hmm.
So one of my initial goals was if we could add time value as an asset class or component of that structure and raise the rate of return on their most conservative assets to a rate that was really sustainable and people were excited about. So on those most conservative assets, what we do is we do start by buying those short-term government treasuries. So the same thing that the money markets are made out of in a normal bank account or high yield money market.
Yep.
And then what we do is on top of that, we trade these very small options contracts that add about 0.2, 0.3, 0.4% biweekly. And the entire goal of that is that we're not trying to hit any home runs. All we're trying to do is just get these little teeny base hits continuously throughout the entire year. And what that does then is it creates a very conservative, same day liquid investment that's target return is about 12% per year.
Let's talk more about actually stock options and then as well puts and some of the terminology. Let's start with helping the audience understand some of the terminology that you may know that they may not know.
Mm-hmm. Yeah, at its core, with what I'm doing is we're generally selling options.
Mm-hmm.
very similar to the way insurance companies cover risk, right? So if you've got a car or a building and you buy insurance on it, now the insurance company knows that not every single car is going to get into an accident every month. They know there's a small percentage that will. And then the value that they get from all of the different insurance policy holders covers the losses on the other side, right? They're very good at articulating and making sure that they make money every
Yep.
month, regardless of the snowstorms or the rain or the hail that happens, right?
True.
Now, the one thing that is different between how the insurance companies function and what I do is that when the storm comes through, the insurance companies have to cover all losses, right? When I'm selling these call options in order to earn that premium each month, I can actually close that out when the storm hits, right? I don't have to ride through that and cover all of those losses. And so part of the way we do that is that we're continuously pulling this time decay off of the options that we sell. However, when volatility does happen, as it's happened many times over the last 5 years, we're able to close those out and make sure that we don't take that ride and we're not at risk for kind of the full market swings.
Well, back to what we just touched on is de-risking an investment, and that's one of your core values and pretty much what you've established as a business that you promise to the client, which I know our conversation, I've consistently heard that from you, and I've felt obviously good in what you've done and the focus that you have with building your practice. I'd also like to move towards that founder that you talked to me about. You don't have to name names or the exact scenario, but I remember you shared with me how he made a complete difference and was actually able to not he was able to retire, and we don't need to say timelines and amounts, but I think it was important for people to know that time that you were able to help somebody get back based on their investment into what you were doing. I thought that was very interesting. Can you share a
Yeah,
little bit on
absolutely.
that?
So this is one of the key differences is if our most conservative pool, right? We've got no exposure to the stock market. We're simply generating options income and then short-term treasury interest rates, right? A normal retirement account, people are really stuck at this kind of 3 or 4% income barrier, right? And if you talk to any financial planner, that's kind of what they target. The reason they target that is because they're usually thinking about the problem of retirement income utilizing bonds and stocks in terms of like an asset allocation solution.
Mm-hmm.
And current bonds, as I mentioned, are only paying 3.5, 4.5%. So if you're going to create an income stream off of it, and the industry standard is to create it out of bonds, that's kind of where you're stuck.
Mm.
Now, with what we do, we generate in a low volatility year about 3 to 4 times that amount. In a high volatility year, we can actually generate about even double that amount.
Mm-hmm.
And so in a normal retirement account, say you've got $5 million, right? On your 4% rule, you'd normally be operating on a yearly income of 200,000, right? For most
Okay.
people, that sounds pretty good, right? Now, with what I do though, even on our most conservative, we're not taking any extra risk, having stock exposure. Instead, we're actually looking about 500 to about $700,000 a year, right? As you can see, is a massive difference and the income potential there. So we've had many clients who came to us from the normal advisor model of stock bond allocations and bond ladders and structured notes, things like that. And as we've converted them even to the safest side where we're literally just government bonds and then options income, we've tripled or quadrupled their income potential. In one instance that I mentioned, the client actually came back to us 6 months later and was like, well, I'm done. I can retire 5 years early. I don't need that extra $2-3 million. You're actually generating more income for me passively than my active employment is.
Interesting.
And what's really cool about that story is they're actually now just traveling the world. And so we manage the assets. We've got no stock exposure. We're just generating the options income for them. We send them a check actually for about $30,000 a month. And I believe right now they're in Australia, but 2 months ago they were in Japan. They kind of send us a postcard and say thank you and have a great time. So it's been pretty cool to see.
Well, it's cool how that can work. I'd like to shift gears here, and I want to transition into the other aspect of what you've educated me on in the past, and that was around pooled funds and how individuals, you could be out there being an investor, you have liquidity up to $100+ million. I mean, I've seen it. And in some of those individuals, capital isn't actively working for them, but
Mhm.
yet they are planning to deploy that capital somewhere. But you, with the strategy that you've created, can you help educate us though as how you manage those type of funds and then allow for individuals that have idle cash to be
Mhm.
utilized correctly?
Yeah, so there's kind of two main issues that I see people run into. One, especially for businesses, they either have an idle float that they hold throughout the year for anticipated emergencies, equipment purchases, payroll
Yep.
taxes, their normal taxes, right? And they don't want to see that money really at risk, but it's sitting there kind of idle in that money market, only yielding that 3.5%. So for those, it's very easy because we can run this strategy, generate a lot more income, as I mentioned, typically more about 1% per month, but still having it available same day if they need access to it to buy that piece of equipment at auction or to pay the IRS their taxes for the year, right? The other issue that we often run into, though, is when we've got a large project, right? So if you're, say, a fund or even a business that's gearing up for a large project, there's a few issues that you run into. So the first one is that, say you want to buy a $100 million business. Okay. And you're going to raise capital for that from general investors. Now, the problem is it might take you a while to raise that 100 million. However, you don't want to pull that into your accounts before you can make the purchase, because every month that it's sitting idle, your investors are getting frustrated because their money's not doing anything for
True.
them. So usually the way that people solve this is by getting a lot of indications of interest or promissory notes. And once they've got that 100 million in promissory notes, they strike the deal to buy the asset or the new company. And then they've got 30 days to round up like wildcats all of this money.
Yep.
Hey, 3 months ago you said you were going to give me $25 million.
Are you in
Today
for
is
it?
the day.
Yeah.
Wire it in. And it's massively stressful to try to go through and then collect all of it, basically kind of just in time funding. Okay. Now, as an alternative, what I've had is a lot of people, they like to have the leeway to negotiate with those deals. Part of what gives you the negotiating power is to have all of the money ready to go and then make the deal that's in your best interest rather than the one that you've got the timing perfected to make
Perfect, yeah.
happen, right? Now, if in your idle cash or escrow account, we're generating an extra 1% per month and it's still liquid when you need it with very small variability, you can actually raise that money a month, 2 months, 3 months in advance. And oftentimes the interest rate there, or the yield that we're generating on that account, the investors are very happy with that. And it gives you a lot more flexibility to find the deal that is right, not the one that is timely, right? And we've
Mm.
ran into this particularly for real estate acquisitions
Mm-hmm.
or for private equity where they're buying companies. Sometimes those negotiations can go on for months to make sure that you've got the right contract down, and allowing them to raise the funds without needing to chase everyone down in the last 24 hours, as often happens, is really, really good for the negotiating table and massive peace of mind for the people that are raising that money. The other part where that runs into then is also construction projects, right? Because if you're not raising money from individual investors, right, that want their money hard at work, not just sitting idle in a bank for months on end, the reverse of that is getting a loan from a bank, right? Now, the problem is when you get a loan, you got to pay interest rates, right?
Yep.
And so oftentimes, even if you've got a very large construction project, let's say it's going to take you 3 years and cost you $200 million, you don't want the bank to give you that $200 million up front, because now you're getting hit with that 6, 7, 7.5% interest rate on day one, even though you're not going to use that money for another 2 years, right? Now, there's two issues that run into that. If you do it piecemeal throughout that 3-year construction project, I've often seen quite a bit of negotiating that goes
On every
on,
term.
right?
Yeah.
Between the bank saying, okay, well, because you didn't take the money up front, now you've got to send us invoices for when you want to spend that money, and maybe we'll give it to you, right? So now you spend 3 years trying to justify getting that $200 million loan you got approved for 3 years ago, right? Just to buy
Interesting.
the equipment or the materials that you thought you had the funding for. Or, right, you've pulled the money, but it's working against you. Right. So lots of times what we'll do for large construction projects then is, rather than playing the game back and forth with the bank so that you're not getting charged interest, we'll pull everything into your own account. We'll then invest it the same way, right? So there's no equity exposure. All
Yep.
we're doing is generating interest or options income on the portfolio, plus the interest from short-term treasuries, right? And now we're 100% in control of when you need the money, right? So as soon as you need it distributed, it's your own money and your own control. You can get it when you need it to do what you want with it to make the construction work correctly. But it's also earning more than the interest rate you're paying, right? So now we've got a positive arbitrage there. As a small side benefit that happens, particularly, for instance, in buyouts, right? Say you do like a Series B fundraise. Very often that money is very quick to be spent when it's sitting idle in the bank. However, when the directors can see that it's generating an extra $100,000, $200,000 per month to help their bottom line, it tends to stretch a little bit further, and people are a little bit more hesitant to spend it on frivolous things. And so there's benefits there on the fundraising side, as well as on the construction side, to make sure that we're generating that positive arbitrage. And most importantly, we're maintaining the full liquidity and control of those assets and not giving it away to a third party just because we're afraid of the interest rate.
How would you speak to an entrepreneur who is now starting to grow their companies? They're starting to make a little extra money, and it's cool, for those out there that are watching. How would you suggest them to make alt investments or opportunities and vet them? Because I know that there's a lot of opportunities out there, right? And I would ask you to help us speak to those individuals out there who are vetting new opportunities right now for alt investments, and how would they go about that vetting process?
Yeah, so typically what I run into is people like investment opportunities that have the potential to either just feel cool or they're the unicorn that could 20x in value, right? And what's actually true is that usually the slow, boring, tedious ones are actually the better one. The way that I try to structure all of the investments and option strategies that I run is to make sure that we win in every scenario. So regardless of whether the market goes up, down, and sideways, or if interest rates go up or down, or whatever happens with inflation, that we win no matter what. The question is just to what varying degree, right? So one way to think about that is kind of the aperture or the range of returns that you could absorb, but they're all in the green, right? Now, very often what entrepreneurs do is they are risk takers, right? They like the idea of what's possible. Now, that's really great for the thing that they are in charge of, and they can stay up till 2 a.m. making happen, right? Like the buck stops with them and they're going to make it work no matter what. The problem with lots of investments, and particularly in alternatives, is that that's what's in somebody else's hands, right? And so if you're taking excess risk in an asset that is out of your hands, or even very illiquid or obscure, it's not really transparent in what they're doing or how, that's usually where people get burned, right? And so what I normally say is like, okay, instead of saying I'm either going to get 0 return or negative 100% return or 20x, how about we look at something that is liquid, accessible, and I can't say the word guaranteed, but incredibly probable to make you money regardless of what happens, right? And it's usually the 5, 10, 15% return consistently that you've got access to for opportunities or emergencies that really course corrects your whole income profile, rather than I put it in a new altcoin and it went to the moon, right?
Oh, I was going to say that as well. I mean, you've got so many people that they basically take investments into their own hands, and then they go out and, hope that they're going to win, right? And this isn't the lottery. You need to be calculated with your decisions, as you've said. And I think that, obviously based on what I've heard from you and just getting to know you a little bit more, that is your whole entire thesis. It's just mitigating risk, but also winning at all costs, basically.
Yeah, a lot of it comes down to intelligent design in the strategy that you're implementing, right? And I know a lot of the entrepreneurs have already figured this out when they write new contracts or they create new partnerships of structuring, okay, this is what I'm going to do if we both do exactly what we say we're going to do. And this is my backstop if somebody doesn't fulfill their requirements, right? They're trying to structure it that their company wins no matter what the outcome is. Now, the trick is you can do the same thing with investments. You just have to be talking to somebody that actually knows how to structure it that way. So, a really common thing that we'll do to, for instance, de-risk an investment, even if it's something like Bitcoin or Nvidia
Hmm.
or something that's a little bit more volatile, is we can actually structure an offset between long dated call options and then offset with options contracts that generate income, essentially creating a scenario where we generate more options income or time decay than we've paid for the upside of the other alternative, thereby creating mathematically a win-win that if Bitcoin falls to zero, we still make money. And if Bitcoin goes up, we also get the upside potential, right? And so for a
Hmm.
lot of family offices and high net worth individuals, we'll go through their portfolio and look at, okay, which things do you want access to, or which things do you want exposure to in the future? And how can we restructure that ownership so that regardless of what the market gives us, you've got more money at the end of the day?
What's your opinion or your calculated opinion, I guess, of both the differences between real estate investing and then as well stocks?
Mhm.
I'd like to get your take on that.
Yeah. So,
Yeah.
on a very basic level, real estate values are dictated by population increase, right? So, if the
Yeah. True.
population
Yeah.
goes up, the demand for housing goes up, right? Offset by new build construction versus old, demolition,
Yep.
right?
Yep.
And so on the very front side, you can look at if the population of the area you're looking at is going up or down or sideways, is usually going to give you a pretty good idea of what the real estate market's going to be over the long term, right? Plus inflation, right? Now, outside of that, real estate tends to move slowly and its value is a little bit hard because it's always based on an appraisal or what you
True.
could get somebody to buy it for, or better yet, what the bank would even lend for it, right? Because very often I've ran into people where they've got an asset that maybe appraises for $30 million, but the bank's willing to give them, 500,000 for it. Okay, well, the value might as well be 500,000 then, right? If
Hmm.
you're trying to leverage that asset. So on the one side, real estate tends to move slowly and has a lot of factors that are kind of out of your control in terms of population or population movement or interest rates or inflation and all of these things. The other thing is it tends to be illiquid, right?
True.
And so I've had a lot of people that have made tons of money in real estate, and that's fantastic. I've also run into a lot of people that have got into a little bit of traps where they've set up real estate stuff and the winning hand is 10 years out, but they need money today. Right? Okay, well that's,
Illiquid.
yep,
Yeah.
pretty hard to deal with then, right? Where you can be right 10 years from now, but if you're wrong in the next 6 months, you might have to close shop and kind of give up, right? And take the losses. The good thing about the equity market is that it is liquid, right? So even though the fluctuations and the volatility of it may be greater, part of that is because there's a continuous show of where the value of that asset is. Now, liquidity is an incredibly, I think, underrated skill because people always think things are going to be golden. And then inevitably, 3 years later, something goes wrong. The wife has cancer, the economy
Mm.
dips, the federal government changes a law, and now you can't export copper anymore, whatever it might be. And you run into either emergencies or opportunities. And that money that you put in the ground in these different projects you had that are illiquid can come back to kind of bite you in the ass a little bit when you no longer have access to that when you need it. So part of the way I like to structure our kind of the equity open market stuff is that day one is everything's going to be liquid, right? If you need access to your money, you need
It's
access to
liquid.
your money, right? The second thing is how can we then mitigate or take advantage of the volatility of the market up and down to create that win-win scenario, right? Through intelligent design of the strategy rather than what I call kind of the diversification trap, right? Where you talk to a lot of advisors and their solution is trying to diversify you into oblivion.
Hmm.
That is spreading out the risk. It is not getting rid of the risk, right? Which is tend of how I like to structure it. So first off, maintain liquidity. When people need money, they need money for their opportunities or their emergencies, right? And then the second part of that is structure it in a way where we win no matter what, just to varying degrees. My motto in trading, right, it goes back a long time, is that in having a conversation with somebody about whether we made money or we made more, maybe we sold early and it kept going up. My comment is that I'd rather have that conversation than the alternative, right?
True.
Where we lost money. And so the idea of structuring it where now your returns are kind of gated between, let's say, 2% and 23% versus a scenario where you have the potential that you win the lottery and it's up 400% or it went to zero. Right
and
now,
you lose everything.
Yep. Typically, right? If you pair off the extremes, you can pair it off in a way that ends in the green no matter what, which allows you to play the game again.
Yeah,
right?
That's good. I would assume that there's many people that come to you that seem a little bit intimidated by maybe the stock markets because they just don't know about it, right?
Mm-hmm.
Can you share with us a little bit about the scenario of how you deal with those individuals? And is there a way that those people can get started, educating themselves, number one, but then also working with you, number
Mm-hmm.
two?
Yeah, absolutely. So really common, honestly, even when we talk to really intelligent, well-developed family offices with hundreds of millions of dollars, very often they don't necessarily have an options expert on their team. So even on the highest level, what we'll often do is run what we call kind of test accounts, which is the idea that we've explained it. It makes sense mathematically. Now the trick is let's see it in real practice, right? Let's put it out there. We're at war, we're out of war, interest rates are going up or they're going down, right? New inflation reports or job reports. How does it actually play out in the real world? And very often then we'll go through and we'll set up a test account. Depending upon the strategy, these can be as low as $10,000 or as high as $100 million. And we can let it run so that they can experience it. Now, one of the cool things about the way we do it is that all of the trades that we're placing, the clients can see, right? And so they can actively see, okay, what are the fees that we're paying? And then what is the income that's being generated in response to the market impetus in order to justify that or make the accounts grow, right? And so one of my rules from day one was in starting the company and running it was absolute transparency, right? And that in the value I add, it has to be visible to the client. Right. So even if I worked my magic, if the client couldn't see exactly how it made them money, it actually wasn't worth it. Right. And so I had to trade in a way that they could see and in a way that they could see every step of the process so that they could see it working or not working right away. And then on the liquidity side, I also set up all of the business opportunities that I pursue with people and kind of investment strategies. I have no lockups or contract periods at all. Is that if it's not working, we can stop at any time. In contrast, though, if it is working and I am adding value to the accounts, I can show it and it's provable and I can re-earn their business every time we sit down together.
That's good.
By showing them the continuous value that I add to the accounts, right?
That's what we started with. We started with value and how you, in essence, went from working for Fidelity with having this vision of service at the highest level.
Mm-hmm.
And that's what I've seen from you and what we've talked about today on the podcast between, your very analytical approach to de-risking to providing immense value for people's current capital that they have to be able to putting that to work for them. And then now helping those that are just getting started and, kind of walking them through, because that's one of the biggest things is how can we kind of ensure someone's success? I mean, we don't guarantee anything like you said, but it's really nice to be able to know that you have somebody like yourself that's going to walk right alongside, and kind of answer the questions that are necessary.
Mm-hmm. Yeah, so. And that's really one of the fundamental differences in what we sought to achieve in running the company is that we wanted to meet with people regularly. So we generally meet with all the people we work with quarterly rather than annually. And a big part of that is as the market changes, as interest rate changes, as the person's individual tax situation or cash flow changes, staying on top of what's going on so we can make sure that the risk that we're taking on the one side matches up with the client's individual situation on the other so that we're always kind of in sync, so to speak. Also, the idea that on the tax side, right, there's lots of different tax strategies that have to be implemented at different points in the year, particularly for owners as they get their K1s or their extensions or based on their fiscal year. And so as we meet throughout the year, making sure that you've got the money when you need it, it's generating the income that you need, we're taking the right amount of risk for kind of the time duration of the asset we're working with, and or the funding round that they're dealing with, or the construction project, kind of whatever's going on. A big part of it then was that in order to do things correctly, we had to do the hard work of doing the right thing every week, every month, every day, right? And generally speaking, it means that it's tedious, right?
Sure, because you're doing things that others won't do or don't do.
And as anyone that's ever created a business knows, the secret to success is normally that same thing: doing the right, tedious thing every day, every week, every month, right? Consistently, right? And it's when people go off script that they tend to get in trouble, right? It's like, okay, if I know the right way to package my product, right, to that high quality standard, it's tedious to do that. But if I do that every single time, all of my clients will love it and they'll share it and the brand will grow, right?
Well, yeah, your referral rate is pretty large. I know we talked about that earlier, but I'd like to switch gears a little bit into the vision of the future of Alpha Wealth Funds. Do you have your long moonshot for the company? Can you share that with us?
So the big goal right now is right now we're about a $300 million SEC registered firm. We currently have about 5 hedge funds up and running and clients all over the United States. The big goal is, as we're pushing with our current team to cross $1 billion in the next year, a big part of that is we've been getting plugged in. We're actually run a lot of these investment strategies or option strategies for other family offices and institutions, insurance companies, and other RIA firms, as a way for me to kind of figure out, in all of the different work that people are putting together, there's lots of opportunities where I can essentially insert myself into their current system in a way that continuously adds value for them, right? And as we've done that, we've discovered more and more of these opportunities where there's kind of low-hanging fruit, so to speak, where we can come in, fill a position that is being left vacant right now and add value on a continuous basis. And that's kind of our big goal, is in generating that value and helping more people accomplish what they're looking for. We're kind of pushing towards that billion mark. And one other way to view it is, for most people, the time value, right, of their assets is just slipping through their fingers, right? They're not leveraging that. It's very similar to having a corporate building, but not renting out the office space, right? And a big part of where we find that low-hanging fruit is looking through and saying, hey, how can we capture the time value on the assets you already own in order to generate more revenue for what you want to accomplish with your business or your company?
Well, our community here at AHQ, we're excited for, obviously, you and the partnership that we've just solidified throughout this year. But at the end of the day, your brand is growing. The service to your clients is continually growing. You've got happy customers. And, I can't wait to see the future for you, man.
Absolutely.
But we just want to say thank you so much, Chase, for coming on the AHQ podcast. Guys, I hope you enjoyed today's episode. Now, before we leave, I want to make sure that you have a moment to be able to share how people can get a hold of you and what's the best way to go about getting started with the Alpha Wealth Funds.
Yeah, absolutely. So one of the easiest ways, of course, is our website or our public phone number, where they can call in or email us, where we can reach out and kind of look over their situation and figure out, with what they have going on right now, where is that particular place where we can insert ourselves and, add value and improve their situation. So the website, of course, is www.alphawealthfunds.com. And that will have, phone numbers and whatnot posted as well to be able to reach out and make that connection.
Awesome. Well, again, thank you guys for taking a look at the AHQ podcast. If you want to learn more about diversifying your funds, about how to buy a company, sell a company, as well as meet people just like Chase here, we're thrilled to be able to create these podcasts for you. So make sure to like, subscribe, comment, share, And we can't wait to make another podcast just like this for you coming soon.